So a typical client journey with Involved Loans, it starts with an initial meeting, and that initial meeting is just us getting to know the situation that you're in, having a look what your assets and liabilities are, what your income and expenses are, so that we can show you what your borrowing capacity is and look at options with lenders. From there, we then go and find the appropriate solution. A lot of the time that does involve going to obtain special pricing from lenders. We don't just take the standard carded rate. That process is anywhere from 1 to 2 days waiting for that lender pricing to come back so we can give you your best solution. The next step is each lender then requires a certain amount of paperwork and information that they want. This can differ from lender to lender. So once we know exactly where we're going to go, we can let you know exactly what that lender will require so we can put together your application. Once those documents are received, the team will put your application together. They'll lodge that to the chosen lender, and then ideally the next step is us giving you a call congratulating you on your formal approval. Once a formal approval's received, the mortgage documents or the loan documents will be issued. These days, most of those are electronic and they're DocuSign, which makes the process really easy. We'll catch up with you and review those documents just so you understand what you're signing. And then once you've signed those documents, they're electronically sent back to the bank. In the event that they are paper, ideally, we'd like to catch up with you at that process and just roll through those paper documents and make sure they're done properly. So once you've signed your loan documents, they'll go back to the lender either electronically or via post. That's when your solicitor gets involved and they will book in settlement with the lender and ideally your purchase or your refinance. So during that process, we make sure that you have your insurance in place and make sure that you're kept up to date through the process. Once the settlement happens, it's the time to get excited. It's the time to celebrate. We'll make sure we send you all your information. So when your first repayment is due, all your loan account details, and that sets our annual review date so that we can make sure ongoing your loan remains competitive. So the 5 C's in lending, what a lender looks for in an application, that is capacity, character, credit, collateral, and conditions. So first of all, capacity is your borrowing capacity, calculated by your income and expenses and how much you can borrow. Each lender looks at this slightly differently, and it's something that we'll go through with you in your personal situation. The next is your character. Now that's not, are you a good person? That is financially, what do you look like? And are you a safe bet to a lender? So what do you do and how long have you been doing it? What does your assets and liabilities position look like? And do you look like you're going to be a safe bet to a lender to pay that loan back? Credit is the next one, and most people have heard of their credit file or credit history. These days, credit files are what they call comprehensive. So they not only measure what we used to know as a negative reporting or any defaults, bankruptcies or bad history, but they also look at your current loans, the last 2 years worth of the repayments on those loans, and you do have a credit score. Now, Equifax is the company that manages this in Australia. You can get onto Equifax and check your credit score. Anything over about 550 for lending is gold. So if you want to check your credit score, you can do that yourself. Make sure that yours is over 550. The way to improve that is just pay your debts on time. Avoid applying for finance unless you really need it, because each time you apply, they have a look at your credit file, which comes as an inquiry on that credit file. So the next C is our collateral, or that's what are you buying, what's it worth, and where's your deposit or your equity coming from. So a lender's main decision or main investment is in you as the borrower. The collateral or the property is there in case you run away, go broke, don't pay. They're going to come and take that property and try and recover that debt. So when you do go and buy a property, you're going to put an offer on that. The lender's always going to do a valuation to check that you've done your homework and you're not paying too much. Your deposit or your equity can come from cash or savings, or if you've got a property, it can come from the existing equity in your current property used to purchase or borrow all of the next one. The last one is conditions on the loan or on the property, and this is a little bit less common. Conditions is something that might be changing in the future, so are you due to have another baby? Are you on maternity leave at the moment and returning to work? Or something around the property, and some things to look out for, mainly on houses, is high voltage power lines. So if your property is within 50 metres of high voltage power lines, lenders don't like it. Also, if it's a leasehold property opposed to a freehold property. Pretty uncommon in Australia, but it does happen. So based on those 5 areas, that's what a lender's going to look for and make an overall decision on whether they're happy to approve your loan or not. So how does a lender assess your borrowing capacity? We're going to have a look at a live example here of how a lender assesses a couple's borrowing capacity looking to buy a house for about $1 million and borrow $900,000 or a 90% loan. So we have Bob and Mary. Bob works full-time on $150,000 a year. Mary's part-time at the moment. She's earning $75,000 a year. They're a couple with 2 young kids, 2 young boys. And they do have a couple of debts at the moment. So they've got a $10,000 credit card and they've got a $40,000 car loan, which they're currently paying $800 a month on. In their living expenses, Bob and Mary also have private health insurance, which is currently costing them about $250 a month. If we have a look at their borrowing capacity, based on their current situation, we said they wanted about $900,000. As you can see, it's a little bit short in this maximum loan amount or max capacity column on where they would like to be. Now, they're first home buyers, they're buying in Southeast Queensland, so under $1 million, they are eligible for the first home guarantee scheme, which allows them to borrow up to 95% with no lender's mortgage insurance. What we're going to do is we're going to have a look at different ways that we can increase their borrowing capacity. So the first and the easiest way to increase your borrowing capacity is to reduce your liabilities or get rid of some debt. Credit cards are a big one. If we cancel their $10,000 credit card, you can see it actually increases their borrowing capacity by about $45,000. Mary also has a $10,000 HEX debt at the moment. So if she was to pay that HEX debt out, or there are some lenders that will look at if you're going to pay that out in the next 12 months, they will ignore that current HEX debt. That also increases her borrowing capacity. Lastly, we're going to have a look at that car loan. So that car loan, it's only $40,000 owing. They're paying $800 a month, but if we cancel that car loan out, if they've got some savings to pay that car loan out, by cancelling that car loan, it actually increases their borrowing capacity by about $100,000. So just by reducing some of their liabilities, looking at options to either close a credit card or close their HEX, we've increased them from about mid-800s max loan amount to about mid-900s, which can make a huge difference when you're going to look at a property. The other ways to increase borrowing capacity, which is a little bit harder than the first, is to increase your income. So a very rough back of the napkin calculation on your borrowing capacity, as long as you don't have too many other liabilities such as credit cards and car loans, is about 5 times your gross income. So if you're, as a household, earning $200,000 a year before tax, your borrowing capacity is close to $1 million. So not exact, depending on how many adults and kids, but it should give you a rough guide of where you need to be. What is my credit file and how do I know what a good score is? Equifax in Australia is the main source of credit files that most lenders use. You can go onto the Equifax website, which we've put up on the screen, and you can check your own credit file. Now, a good score for lending is 550 and above. Credit files being comprehensive, what they measure is the inquiries that you make, and it actually shows you your last 5 years worth of inquiries. It also shows all loans that you've got or had in the last 2 years and your repayment history on those loans. So whether you've been on time or whether you've been late. Now, when they look at repayment history, on the credit file, 0 to 14 days late is actually still considered as on time. So if you've missed your payment by a day or two and then caught up, don't stress, it's probably going to show as on time on that credit file. But if you're anywhere from 14 to 30 days late on a loan, it will show as a missed repayment, which when you go for a loan, the lender's going to see and they're going to question. So please make sure you're paying your loans on time. The other thing that a credit file shows is also any financial hardship that you might have gone into. This was really common around the COVID era when people put their repayments on pause. That's actually financial hardship. If you do go into financial hardship, a lot of lenders will want to see you back in front or back caught up again for a minimum of 3 months before they'll look at any further lending. Defaults and bankruptcies is what the credit files used to show, which is what we call negative reporting only. And that has to be a debt that goes bad for a while, normally a minimum of 3 months before it can be considered going towards default. And bankruptcies is something that you go into if things get really bad and you can't pay your bills and there's no way out. So hopefully you're not in that situation. But jump on, have a look at your credit file. As part of our process in Evolve, we do a credit check on everyone before they get to application, just to make sure that we know exactly what we're dealing with before we go to the lender. So how much deposit or what sort of deposit do I need to buy a house is a common question we get every day. Now, if you're looking to utilise the first home guarantee scheme, so in Queensland, that's a property price cap at the moment of $1 million in Southeast Queensland and $700,000 for the rest of the state. You'll get away with just 5% of what you're looking to purchase plus your purchasing costs. Now, by purchasing costs, we mean stamp duty if it's applicable, solicitors' fees and registration costs. In Queensland, at present, up to $700,000, there is no stamp duty. So if you're buying something for $700,000, you need 5%, which is $35,000, plus your solicitors' fees, legal fees and registration costs, round figures about another $5,000. There is another option which is known as a family guarantee or family equity loan. So we've put an example of what that looks like on the screen now for you. Now, this is not the old guarantor loan that most of our parents or older generation remember, which is we can't afford the loan, so let's throw the parents on so we can get it. The borrowers have to stand on their own 2 feet when it comes to affording the loan, having the borrowing capacity, and being in a position for the bank to say, yes, we're happy to lend you that amount. Where the guarantor comes in is we're using equity in their property where we can actually borrow up to 100% of the purchase price, and some lenders will even include purchasing costs in that amount. How it's structured, as you can see on the screen, is 80% of that, or $640,000, is secured against the borrower's property. The remaining 20%, or in this case $160,000, is secured against the borrower's property, but also the guarantor's property. That gives a lender enough security so that they're happy to lend 100% of the purchase price, and like we said, can even lend 100% plus purchasing costs. Now, it's up to the borrower to meet the repayments on the loan. The guarantor is not a servicing guarantor, so if the borrower misses a repayment, the guarantor is not going to get a tap on the shoulder and say they're $800 short this week, can you please cough it up? How a guarantor will come into it is if the borrower run away, go broke, doesn't pay, then the bank will come and sell their property first. If there is a shortfall, that's when the guarantor will get a tap on the shoulder. Now, this is not a long-term solution. So we want to release this as soon as possible. Now, for the borrower, ideally, once the debt level sits at 80% of the value of their property. Now, in this instance, if they paid $800,000 for the property, once their property increases to, say, $1 million in value, if the debt sits at less than 80% of that, or 800, then the guarantor can be released. Now, at that time, it's not a full application. They're not borrowing any more money. All the lender's checking is what's the valuation of the property? Is that equity there, or is the debt level sitting at 80% of the value? If so, they sign a form and off they go. Really popular way for people to use the bank of mum and dad where no cash or money changes hands, but they use that equity that they built up in their property over years to help their kids get into the property market. There is a security or a mortgage on the guarantor's property. In the example that we use, that's $160,000. That's not a financial liability for the guarantors. So if they go for another loan, they don't have to declare that as a loan they have to repay. It does, however, chew up $160,000 equity in their property. So if they're looking to use that property for further lending while this guarantee is going to be in effect, they just need to know that that $160,000 is going to be used. They can sell the property, but something needs to be done with the loan. Usually what happens at that time is we go back and we get a new valuation on the borrower's property. We borrow as much as we can to try and soak up that $160,000 loan. If there is a shortfall, they can still sell the property, but they just have to pay that portion of the loan out, and there's an IOU to the parents in the background. If you're a first home buyer and you're looking to purchase without the first home guarantee scheme, the minimum deposit you'll get away with is around about 10% of the purchase price. So 5% covers your deposit, the other 5% covers your lender's mortgage insurance, because if you're not part of that first home guarantee scheme, unfortunately you've got to pay lender's mortgage insurance unless you have a 20% deposit, and the registration and solicitor's costs. So not an exact, but something to aim for. What first home buyer incentives are available and can I use them all is another question we get a lot. Currently, at the time of filming in Queensland, the stamp duty concession for existing properties is up to $700,000 purchase price, there's zero stamp duty. From $700,000 to $800,000 purchase price, there is a scaled concession. And over $800,000 purchase price, there's no first home buyer incentive. On vacant land, so if you're looking to buy land and build and you're a first home buyer, you don't pay any stamp duty regardless of purchase price of the land. The next is the first homeowner's grant, which at present is $30,000. That's being reviewed again very shortly. The property price cap at the moment, so the max you're allowed to spend on land and build is $750,000. The 5% deposit scheme or first home guarantee scheme allows you to borrow up to 95% of the value of the property without paying what they call lender's mortgage insurance. The property price caps for those at the moment at Southeast Queensland's a property price cap of $1 million, and the rest of Queensland, or what they define as regional Queensland, is only $700,000. Once you tick over that, even by $1, then lender's mortgage insurance does apply. Help to buy is the last one, and it's often a little bit misunderstood. That's where the government actually takes an ownership in the property that you're purchasing. If it's an existing property, that ownership is up to 30%. If it's a brand new property, they will actually take ownership up to 40%. Now that's very limited with lenders. So there's only 2 lenders on that scheme at the moment. The beauty of that is you only have to be able to afford, if we're looking at an existing property, your borrowing capacity only needs to be up to 70% of the value of the property. You don't have to make repayments on the government's portion or their 30%. You only have to make repayments to the lender on your 70%. So it does allow people that might be stuck in a certain bracket based on their own to move up into that next bracket and hopefully get a property that's a little bit better and get them in a better location, or get them into the market at all. At the moment, it's the same property price cap as the first home guarantee scheme, so $1 million in Southeast Queensland, $700,000 in regional Queensland. Do I need a pre-approval? So pre-approval isn't essential when you're buying a house, but it is a good idea. So what a pre-approval entails is a lender looking at your situation saying, are they happy with your income, your situation, and are they prepared to give you a certain loan amount? The part that the lender can't look at until after you sign a contract is the property itself. So if we go back and we have a look at the 5 C's in lending, they can have a look at your capacity, your character, and your credit, but they can't look at the collateral or the conditions on the property. So it is an approval as far as you can go, but it's not an approval in stone. The benefits of having a pre-approval is you are halfway down the path. It does give you better bargaining power with an agent or with a seller saying that you've got your finance pre-approved and ready to go. The only thing being of when you put an offer in on a property, the lender is going to do a valuation to check that you're not paying too much. So in the event that you can't pay, they're not going to lose out. And they can't do that until you sign a contract. So while a pre-approval is a lender looking at you, there is still that next step of them looking at the property. Now, pre-approval takes around about, depending on lender, around about a week to obtain, some a little bit less, and they are valid for 90 days. Yeah, so it does give you some confidence to go out there and bid on your property. The benefit around timing is often a finance time on a contract in Queensland is 14 days. If you do have a pre-approval and it is a competitive market or you're in a multiple offer scenario, you can pull that time frame down from 14 to 7, which often can be the difference between you getting the property and not. So what does a conveyancer do, and do I need to use one? A conveyancer, in our opinion, is an essential part of the process. So they will act on your behalf. They make sure that the contract, and if it's your first home, a good idea to get a conveyancer or a solicitor to review the contract before you sign it, to make sure that you understand what you're signing when you're putting your offer in. They will make sure that the building that you're going into is fully approved. If there's any structures, so as an example, a shed or an extended patio, has that been approved with council? They'll liaise with the other side upon those finance and building and pest clauses to make sure that you adhere to your contract conditions and satisfy those conditions when they're due. And then leading up to settlement, they'll make sure that the rates and the water adjustment with council are all done up to the date of settlement. That when you're walking into that settlement date, you're not walking into anyone else's debt, that everything's squared away come the day of settlement. Booking that settlement process in and making sure that it's coordinated with the seller, your bank, their outgoing bank or mortgagee if there is one, that all those numbers are squared away and that that settlement process is going smoothly on the day is actually a pretty stressful time. So for the cost of most conveyances, it's definitely what we believe an essential part of the process and money well spent. So how much deposit do you put down on a contract when putting an offer on a property, and does that count towards my total deposit? There's no standard amount here. So the maximum that you're allowed to put down is 10% according to REIQ contracts. What it is it shows the seller that you're serious in proceeding with your offer. Now that deposit amount has to come from your cash. It can't come from the lending because it's usually paid a day or two after signing of the contract or after you've signed and the seller's signed and accepted your offer. It does go towards your total deposit. So if we've worked out you need $50,000 total deposit for your first home and you go and put down $25,000 at the time of signing, then that 25 does go towards that total of 50, so that upon settlement day, you've only got a further $25,000 to pay. A good figure to work off as a deposit, if you have the cash to do so, is anywhere between 2 and 5% of the contract amount as that initial deposit. Now that does go into usually the agent's trust account. If you pull out of the contract for any reason, be it subject to finance or building and pest, if finance isn't approved, which is unlikely, or there's a building and pest issue with the property, then you do get that entire deposit back. So it's only if you go fully unconditional on the property that then counts towards your total deposit. What's some tips that you can do to put you in the best position when offering on a property? So the first and probably most important tip is to know and research the market. Go and attend open homes. Have a look at sites like realestate.com and properties that have sold. RP Data or CoreLogic is another great site that most sale properties are registered on, the sale price and when they're sold. Get a feel for your local market so that when you are looking and when you're hunting for that property, that you know what good value it is and what it is not. A good rule of thumb that a lot of property investors use is you have to look at 100 properties to put an offer on 3 to get 1. So if you can get some time in the saddle and start researching that market of yours and make sure that you know and understand the market, that's going to put you in the best position to know which property is right for you. The next one is to understand the seller's situation. So most people, when they're negotiating, they just negotiate on price. There's so much more to a deal than price. So understand, is the seller looking for a fast settlement, or do they not have anywhere to go yet and they'd like to stay in the property post-settlement? Understand if the seller's looking for a fast settlement and if the property is vacant, that's usually the case, or if they're in the property and they might not have anywhere else to go yet, are they looking for a longer settlement? They might be willing to stay in the property, either you settle early and rent it back to them, or give them a longer settlement to find some accommodation post-settlement. So just don't always look at price, talk to the agent, talk to the seller, understand what they're looking for and try and negotiate or put your offer in terms of meeting their needs and meeting yours. Ensure you know your borrowing capacity so that you also know your purchasing limit. That sort of goes without saying, but understanding what your max price is and what your budget is going to avoid you looking at properties that are completely out of that budget. So be confident in your deposit amount that's going to go on the contract. A good rule of thumb is 2 to 5% of the purchase price. And remember, that has to come from your cash, so it can't be lent. Ensure you've got that cash in your account and that you can do without that for the period of the contract. That deposit amount on the contract does go towards your total deposit, and that usually sits in the agent's trust account so that they know that you're serious in proceeding with that purchase. When putting an offer in, put an offer in writing. So ask the agent, ask the seller. Often this is done on a contract. Don't be scared about that. A contract isn't binding until the seller signs it. But if you put your offer in writing, one, it shows you're serious. Secondly, the agent has to present that to the seller. You got to remember, the agent is working for the seller. Their job is to get the best possible price for their seller. So if you put an offer in writing, they have to take that to the seller. It gets considered seriously rather than just a verbal offer, which might not even make it to the seller sometimes. Be clear and confident with your offer. Like we said, know your market, do your research. That allows you to come armed and prepared with recent sales in the area of comparable properties, justifying why you have come to your price. When do I need to get insurance on a property? If you're purchasing a house in Queensland and you sign a contract, you have an insurable interest in the property 24 hours after you sign the property. If something happens to the property while you're under contract, the current owner doesn't have to claim on their insurance. When you go unconditional or when you issue your formal approval to your solicitor and they satisfy that finance clause on the contract, you have to ensure that insurance is in place. Okay, that covers you all the way through to settlement. At the time, the property is not in your name, but because you have that insurable interest, it covers you in the unlikely event that we might get a natural disaster or something silly happens during your 30 days or 60-day settlement period. Can I buy at auction? As a first home buyer, auctions can be a little bit nerve-wracking. So an auction offer is an unconditional offer. There's no cooling off period, there's no finance clause, there's no building and pest clause. If you put your paddle up on the day and you're successful, you have to buy the property whether you like it or not based on the auction terms. So we're not saying don't do it, we're just saying be aware of your risks when you're going into that auction. Ideally, we want to make sure that your pre-approval is in place. Now, the pre-approval is a lender liking you, but they haven't had a look at the property yet, so it's still subject to evaluation. When a lender does a valuation on a property, if for some reason the valuation comes in less than the purchase price, the lender is going to lend off the lower of the valuation or the purchase price. If you're proceeding with only a 5% deposit, that is a pretty high risk. We probably suggest that you stay clear of auctions as you don't have any room or margin for error for that valuation. Now with auction as well, there are auction terms that the auctioneer is going to read out on the day of the auction. That includes a deposit payable, usually 1 to 2 business days from the auction. Now that has to come from your cash, so you've got to make sure that you've got those funds available. There is what is known as a deposit bond that can be used in substitution for cash, but you have to okay that with the auctioneer prior to an auction. So bidding at auction, yes, you can do it, but just understand your risks, do your research. If you are going to bid, set yourself a limit, be very disciplined, don't go over that limit, don't let emotion get carried away. Once an auction happens, if it doesn't sell at auction, and a lot of people who are a little bit worried or concerned to bid at auction, you can put in an offer after the auction on what they define as normal contract terms. So be it either subject to finance or subject to building and pest. Most owners or sellers will offer a building and pest with the auction. So if you are going to bid, make sure you review that before the auction and get the auctioneer to send you those auction terms. Run that past your solicitor and just fully understand what you're getting yourself into before you get excited and think you're on the block and throw your paddle up on auction day. So what can I do to ensure that I'm in the best position to proceed with my first home? The first step is know your borrowing capacity and know your limit. Also, do a budget. Understand what the repayment's going to be, weekly, fortnightly, however you budget. Second thing is have your deposit ready. So make sure that you've got your deposit in the account ready to go, not only to put down on the contract, but also to proceed with the finance. Ensure your bank accounts are tidy, no overdrawn fees, make sure that all your loans are paid on time. And when it comes to your accounts, they're not going to go through it line by line and scrutinise how much you spend in takeaway food each week. The big things they're looking for is can you manage your money and make sure that there's money in your account, and are there any bad habits? Gambling's probably the worst one that the lenders see that they don't like. So just make sure your bank statements are as clean, as tidy as they can be. And the last one is have your pre-approval ready. So that takes about a week to organise. It's good for 90 days. It does get us most of the way down the path. It gives you confidence, but also the seller confidence and the agent that if you're going to sign a contract, that you're going to be able to proceed with the purchase. So what's the next step to get towards your first home? It's really understanding your position, understanding your borrowing capacity, what it's going to cost you on a week to week. So getting that pre-approval in place. Reach out to the team at Evolve, book a meeting, understand where you stand, put a budget together, and ideally put a plan in place to get you into your first home. So how does finance work for land and build, or land and a construction loan? So the borrowing capacity isn't any different whether you're buying an existing property or you're looking to do a land and build. Ideally, as a first home buyer, you want to get your land and your build approved all together, especially if you're looking to use the first home guarantee scheme. In order to do that, you have to find your land and sign a contract on the land. From the builder, you also need a building contract, so a fully signed building contract. What's known as building plans, which is just site plan, floor plan, and elevations, and then your building specifications or inclusions, or what's included in the contract. So is it fully air conditioned? Is it granite bench tops? Do you have 2.7 metre ceilings? The reason being is the lender's going to value what they call the completed product. So they need to pass those documents onto a valuer and say, Mr. or Mrs. Valuer, once this house is complete, what's it going to be worth? Now, how do you pay a construction loan? So usually when you've started your land and build, you're either renting or you're living at home and you've got some expenses, living expenses that you have to pay. So you're not paying for the full amount of debt or the full loan up front. A land and construction loan is progressively drawn. That first drawdown is usually the land only. Now, most of the time that loan all the way through to construction or when you move in is interest only on your drawn balance. So we put on the screen now how to calculate that interest. The lender doesn't actually give you a repayment table. So like all interest only loans, interest is calculated daily on the loan balance, charged monthly. So initially the land will settle, the bank will pay the land amount out of the loan, and then the builder is usually paid on around 6 progress payments. Now this progress payment schedule can be found in your build contract. We put an example for you on what is usually found and the amounts that are usually found on a typical house build. Those stages are your deposit, your base, your frame, enclosed, fixing, and final. And we've put what amount is usually at each stage. Now each build is going to be different, each house is slightly different, but what happens as an example is once your base goes down and they send you an invoice, the bank then pays that invoice out of your loan, which increases your loan balance and therefore increases the amount of interest that you're going to be charged. So initially you're only paying for the land. As the build progresses, the loan increases, therefore the interest bill increases. But ideally, this is only usually over about a 4 to 6 month build time.